Good afternoon, everybody, and welcome. This is our annual Dow Lecture. The Dow Lecture was established in honor of the prominent economist Christopher Dow, who was a former deputy director of the National Institute of Economic and Social Research. I should, of course, have introduced myself first. I'm the current deputy director of the National Institute of Economic and Social Research. But unlike Christopher Dow, I didn't set up NISA's quarterly economic outlook. He did that. I didn't set up the OECD's quarterly economic outlook. He did that. He was an incredibly, prominent economist, as I said earlier, but in particular, he was an economist who very much believed in economics for policy. He was not one of those who thought that sitting in an ivory tower, let's say somewhere in New Jersey, inventing an amazingly complicated mathematical model, that wasn't what economics was about. What economics was about was making better policy. And so we've created the annual Dow Lecture in his honor on macroeconomic policy. It's one of 5 public lectures that NISA hosts each year. To give you an example, a couple of former speakers, we've had Professor Martin Wheel, CBE, we've had James Bullard, President and CEO of the Federal Reserve Bank of St. Louis, and we've also had Professor Silvana Tenrell, who is an external member of the Bank of England's Monetary Policy Committee. This year, I'm delighted to welcome James Talbot, who's currently the Executive Director for International Work at the Bank of England. And he became the Executive Director in 2023, following 6 years as just the Director of the Bank of England's International Work. Executive Director, I mean, basically, he was doing the work of an Executive Director, but only paid a slightly lower grade of a Director. Anyway, he's Executive Director now, where he said he is responsible for all of the bank's international analysis and risk assessment, so supporting all of the bank's policy objectives. James sets the international strategy for the bank and is responsible for the development of international policy in G20 and G7, as well as at the BIS, the FSB, and the IMF. Today's talk, though, is going to be about climate change, the macroeconomy and monetary policy. What's the connection here? Well, James is also the bank's executive sponsor for climate, overseeing the delivery of the bank's climate policy work. This has been an area the bank's moved into over the past 10 years or so. James represents the bank in a number of international fora and committees, and including chairing the Network for Greening the Financial System workstream on monetary policy. I should say, the Network for Greening the Financial System, we're very big fans of theirs in NISA because they use our model NIGEN to run their economic scenarios. James's other roles at the Bank of England have included being head of monetary assessment and strategy division, advising the MPC on monetary policy tools, implementation and strategy. He's worked as a senior advisor on domestic and European macroprudential issues in the Financial Stability Directorate and led the preparation of the MPC's quarterly forecast. He also represents the United Kingdom and has represented the United Kingdom as a member of the executive board at the International Monetary Fund in Washington, D.C. He has a degree in economics from the University of Cambridge and a master's degree in economics from the London School of Economics. I should say I've known James since he started at the bank, which was not such a long time ago. Of course, I started at the bank a very, very long time ago. So, anyway, I've rabbited on way too long already. I'm going to hand the floor to James, who's going to tell us all about climate change, the macroeconomy, and monetary policy. Thank you. James Talbot.
Thank you very much, Steve, for those kind words of introduction. Let me start by saying that it's a real honour to be invited here to give the 2024 Dow Lecture, and I want to thank NISA for the invite. But before I say anything else, I'd also like to start by thanking 2 of my colleagues at the Bank of England who are sitting at the back, Michelle van der Merwe and Danai Kyriakopoulou, who are really co-authors on this lecture and who have very ably assisted me with my work in the Network for Greening the Financial System. So I just wanted to start by acknowledging and thanking them for all their help and support. Okay, so I'm going to talk today about climate change, the macroeconomy, and monetary policy. And I think it's fair to say that for central banks, this is a relatively new issue for us, and that we've been on somewhat of a journey in the space of understanding climate and climate issues. So when we first started working on climate at the Bank of England, probably about 10 years ago now, our focus was very much on our microprudential and supervisory responsibilities at the Bank of England, essentially ensuring that the firms that we regulate, such as insurers and banks, understood and had a strategy to address how climate change affected their balance sheets. After we began that work, we then started to focus on sizing and understanding the financial stability risk to the system as a whole posed by climate, designing scenarios to help with this. And Steve mentioned some of the scenarios that we've thought through in the past. And the bank ran an exploratory exercise with some of our banks using those scenarios in 2021 to look at those financial stability risks. And that was one of the first sort of climate scenarios that we asked the bank to run. But I'm not going to talk today about any of that. I'm going to talk about a relatively newer area of inquiry, which is the impact of climate on the economy and on monetary policy. And before I say anything else, I should say that I'm speaking here today in my own capacity. These are not the views of the Bank of England statutory policy committees or indeed the Network for Greening the Financial System. But what I would say is that I'm drawing on a lot of work from both of those bodies. And as Steve mentioned in his introduction, as well as being the executive sponsor for climate at the bank, I've been chairing the Network for Greening the Financial System's work on monetary policy for the last 2 years. And some of the material that I'll talk about today, we are about to publish in the next few months. And that represents the work of a large number of central banks coming together to think about these issues. For those who don't know, the NGFS, or the Network for Greening the Financial System, is a globally representative group of 138 central banks and supervisors. And the idea is that we all come together and think about issues related to climate and our core responsibilities. Okay, so with all that said, let me begin. So I thought it would be useful to begin this talk by saying what we take as given. And I wanted to sort of say 3 things here. The first thing I would say is that as central banks, we take the science on climate change as given. We don't try and redo that work or re-estimate it or take a view on it. But what we are interested in is how that affects the economy and the financial system, and therefore the achievement of our statutory objectives. The second thing I wanted to say is that the policies needed to mitigate climate change are for governments, not for central banks to decide. So we take no standing on that, and we take those policies as given. But I think the thing I would say is that, again, these policies could well have economic impacts. And in addition, if there's uncertainty about the path for those policies, that can also have economic impacts as well. And so that's something that we as a central bank need to understand. The final thing I wanted to say is none of this is about whether climate affects our mandate or our objectives as central banks. It's very clear the Bank of England's remit is set by the government, and our monetary policy remit is very clear that price stability is our primary goal. But subject to that, we're charged with supporting the economic objectives of the government. And in all of the work that we've done, we take that remit as given. I think the thing I would say, though, and one thing that I've learned from my work with the Network for Greening the Financial System, is that central banks have different mandates in this space. You have some central banks who don't really want to talk much about climate, don't have much of a remit on climate, right to the other end of the spectrum, where you've got central banks in other countries who are acting to incentivize lending to green activities. So there's a real spectrum from kind of not very much to being quite forward-leaning. But I think if there's one key point I want to make today, I think the key point is that the thing that I think unites that group of central banks, taking the mandates as given, is that if climate change and the policies enacted to prevent it, affect economic outcomes, then that's a relevant consideration for monetary policy, just like any other shock. And that's really the basis for my talk today, trying to dig in and understand that point. So having said we take the science as given. Let me start with two charts from the IPCC. And these charts really show two things. The first thing in the left-hand chart is that temperature is rising. And that means the physical effects of climate change are becoming more prominent. And the IPCC estimates that global temperatures are now 1 degree higher than pre-industrial levels and are set to rise by 0.2 degrees per decade due to past and ongoing greenhouse gas emissions. And as severe weather events intensify and become more frequent and more geographically widespread, so too will their macroeconomic effects. Annual global damages from weather-related hazards have more than doubled in real terms in the past 20 years and reached $275 billion by 2022. So turning to the right-hand chart, to mitigate those impacts, over 190 countries signed up to the Paris Agreement to limit global warming. And those actions, again, will affect economic outcomes in both the short run and the long run. But what the right-hand chart really shows is the range of actions that have been announced so far by governments in the sort of narrow range that you can see in the middle of the chart are assessed by the IPCC to be insufficient to achieve the goals of the Paris Agreement. And that could mean that we see more happening in the left-hand chart in future, or we might see a point that we come to in the future where the policies enacted in the right-hand chart would need to be enacted more quickly or on a sudden basis. And again, that could have economic effects. So I wanted to say that up front, but we take all of this as given. We have no view on it. We just take that as given. So how do central banks think about climate? I think the first thing I'd say is that all central banks need to understand current and expected economic developments in order to achieve our price stability mandates. And if climate change has an economic impact, then it's relevant to monetary policy like any other economic shock. I should say, as I sort of alluded to at the beginning, central banks also have a responsibility for financial stability. And again, as I said at the beginning, climate is a relevant consideration there, but I'm not planning to focus on that part of our remit today. So let me just take a short detour into some previous work by the Network for Greening the Financial System. And this is work that the Bank of England was very heavily involved in. My colleague at the bank, Sarah Breeden, now our Deputy Governor, led some of this work to produce these scenarios. So what I wanted to show here in the left-hand chart is the NGFS has produced a number of climate scenarios, looking at how climate will impact on the economy and the financial system over the longer term. And these are sort of sketched out in the right-hand chart. And the thing to say here is that those scenarios have different combinations of physical risks and transition risks. So essentially, the more we do on transition, the less the physical risks, and vice versa. So you can see in the different quadrants, there is a mix there in this chart. And these scenarios have been used by us and other central banks to assess financial sector resilience to climate shocks. And these scenarios were the underpinning of the exercise that we did in 2021 that I mentioned at the beginning. The right-hand chart, I think, is also quite interesting. It shows the economic impacts of the different scenarios and breaks them down into the effects of physical risks and transition risks. The physical risks are sort of in the sort of turquoise and green bars, and the transition risks are in the grey bars. And it compares those economic effects to a sort of a theoretical no climate change baseline, which obviously is quite an extreme baseline if you think that climate change is going to happen. But it just shows the economic impacts that could happen in these different scenarios. And I think obviously one thing that's interesting to bring out here is that while the transition policies can have a negative effect on growth, they're much smaller than the physical effects. And also, if you compare the two scenarios on the left, where transition actions are being taken, to the scenarios on the right, where there are fewer transition actions being taken, the impact on GDP is a lot smaller. So I think in everything I say today, it's worth having this kind of long-term perspective in mind. But of course, when we think about monetary policy isn't about the next 20 or 30 years. Monetary policy is a lot more focused on the near term and the shocks over the next 2 to 3 years. So the focus in our thinking and the work particularly we've been doing at the Network for Greening the Financial System is over that shorter horizon, thinking about what the effects might be and how we model them. And as well as the impact on the demand side of the economy, obviously climate could also impact the supply side, the natural rate of interest. So lots of variables that are of interest to central banks. And I'll come on as I move through the talk and talk about these different aspects. I think the final thing I would mention is that it's very clear from talking to other central banks that the macroeconomic impacts of climate will very much vary across economies. Within the group, we have oil exporters, oil importers. We have central banks who are very exposed to the physical effects of climate change and ones that are a lot less so. We have central banks in countries where policies have gone further, where policies have gone less far. So there's a really big range of views. And I think one of the really good things about the Network for Greening the Financial System is that there is that diversity of view and perspective. But in terms of doing our work, it's something we need to bear in mind that different economies will be affected differently. So why is the focus here increasing? So as I mentioned at the beginning, we've been doing this work over the last couple of years to try and put together a common analytical framework for central banks when they're thinking about the impacts of climate. And I think one of the reasons why interest has grown is that in many countries, there is an increased frequency and severity of climate-related shocks. And I guess sort of classically as monetary policymakers, when we think about the effects of a one-off shock, we might look through some of those effects. But obviously, or certainly the immediate direct effects, but obviously if these shocks become bigger, if they become more frequent, then it becomes harder, I think, for monetary policymakers to look through those shocks. And indeed, I'll come on and talk about this later, but these shocks in the main may give rise to a sort of a trade-off that we need to manage. And in addition, even if the shocks don't happen within a country's borders, there can be indirect effects from climate shocks abroad, or in addition, climate policies taken abroad. And again, I'll come and talk about that. But just to give one example at the beginning, the 2022 droughts in Germany obviously caused river levels to fall on the Rhine, and that disrupted the flow of goods and caused an effect on global prices and global goods supply. And for a small open economy like the UK, those are effects that we need to think about. In addition, the climate policies that may be enacted could give rise to large, prolonged, partly anticipated relative price changes in the economy. And again, if those price changes happen over a number of years, again, this is something that central banks probably need to think about in terms of achieving their mandates for price stability. I think in addition, clarity and certainty on those policies also matters for economic behavior. If there's uncertainty, firms will have less certainty on investment, households will have less certainty on their consumption patterns. And so again, that can affect economic outcomes depending on the clarity of the future path. And again, there's this point about asymmetric policy mixes, which can give rise to international spillovers. So I'll come back and I'll unpack this in some detail, but I think this is a reason why central banks have started to focus more on this topic. So let me start by thinking about how we've thought about the physical impacts of climate on the economy. And the first thing I would say, again, is that consistent with our focus on the monetary policy horizon, we've been focused really on the short-term impacts of these physical effects. Now, the first thing to say here is that no two climate shocks, I think, will have the same macroeconomic effects. So in the work that we've done at the NGFS, we've tried to come up with a bit of a taxonomy and a bit of a sort of a thought process for thinking through the effects of those shocks. So the first is the nature of the shock. Is it a heat wave? Is it a flood? Is it a storm, et cetera, et cetera? The second is the degree of exposure of parts of the economy to that shock. What's the value of the affected assets? Are buildings destroyed? Are factories destroyed? Is production interrupted? And then in addition, there's a third element, which is the vulnerability of an economy to these shocks. And here things like construction quality, disaster preparedness and response capacity come into play. And I think one of the things we've been thinking about as we've been doing this work is, as well as these kind of different aspects and different economies and different positions, it's also important to think about this resilience threshold for an economy. So what you tend to see when you look at some of the literature is that advanced economies tend to come back better from physical related shocks than some of the emerging markets do. And of course, again, this depends on structural factors in the economy, the wealth of the country, the fiscal capacity, and also crucially the insurance mechanisms that are in place. I think this issue on insurance and the degree of activity that is insured is quite a crucial one actually as we move forward. And I guess the final point I would make is, again, coming back to this point that if these shocks are more frequent, if they're bigger, then you could think of this resilience threshold as being kind of exceeded more often. So again, that's something that we need to think about. So I think all central bankers like transmission diagrams, and so we put this one together for the report. This will be forthcoming in I think we're hoping this report's going to come out in the next 1 to 2 months. So here's our attempt to put all this in a transmission diagram. So overall, we start with the effects from climate change, the physical hazards on the left-hand side, be they acute, so a storm or a heat wave, or be they chronic, sort of more long-lasting, a gradual rise in temperatures. And then these shocks will affect the economy through a number of different channels: demand, supply, financial channels. And I guess the first thing to say is that often these shocks are experienced first on the supply side of the economy. So production capacity is interrupted. The production of goods and services could be impaired or may even come to a complete stop. You can have destruction of physical goods, capital, and infrastructure. You could also have displacement of workers or job destruction. And in addition, there could be effects on total factor productivity as well. And evidence shows that there are negative effects from physical hazards on both labour and agricultural land productivity specifically. And in addition, of course, productivity can be affected when attention and resources are devoted to reconstruction efforts after a shock as well. So that's probably the first place this is going to show up on the supply side. But also the demand side can be affected by these shocks. Destruction and loss of assets can impact households and firms, and that can put downward pressure on consumption, and also the demand for goods that are unrelated to the reconstruction efforts. And these effects will come through a variety of channels, which we've unpacked here on this slide. So the disruption of housing, disruption of wage payments or business income, greater uncertainty in future about growth and income prospects, which can depress consumer and business sentiment, reducing investment and increasing precautionary savings. And as I mentioned a few minutes ago, one of the other things we wanted to get into a little bit in this paper was the effect of insurance, which can limit the economic fallout from severe weather events. However, research suggests that 55% of global losses from physical hazards are currently not insured. And of course, that may rise in the future. So that kind of shock absorbing role there may diminish through time. In the middle, then, we've got the sort of financial channels, which can amplify effects too, including changes in asset prices associated with the destruction of physical assets that I mentioned. But also then you've got the negative impact on the value of collateral that borrowers can pledge as well to secure a loan. And if banks' balance sheets are adversely affected, this can affect their willingness and ability to lend. Although, of course, lending for the recovery effort can offset some of those effects. And so we do think as well that there are some interactions here between these different channels. And ultimately, what I'll come on and talk about in a moment is the effect on economic activity and inflation, which is shown on the right-hand side of the diagram. So let me go into that next. So there's I think, an ever-expanding literature on the macroeconomic impact of physical shocks. But let me try and pull out some of the conclusions from that literature. So maybe the kind of first and most obvious point, the level and growth rate of GDP drops in the short run after a climate shock. And depending on the study, GDP growth rates vary in terms of their decline, obviously depending on the shock as well. But essentially, for the most severe events, we get this figure of around a 0.5% impact on GDP in the year of the shock. And for, significantly larger events, the events are much larger. And again, my points earlier about the kind of the different nature of the economy and the resilience threshold will also apply here. And I think this is a really interesting point as well, which is again, the results suggest that a climate disaster results in a cumulative per capita output loss of 0.25, 0.5, and 1% for high, middle, and low income countries, respectively. This is based on the work by Redats that I'm referencing here. And I guess one thing that's quite interesting is kind of how the economy comes back after this shock. And as you can see from the sort of stylized depiction in the chart here, different studies suggest different things. Some suggest that you can have a reconstruction effort and that will boost GDP growth and you can kind of come back and be better in the future. Whereas others suggest that kind of the level of GDP can be depressed for quite a long time, sort of shown in the stylized depiction in the green line here. And I guess, again, the point here, I think, for us to think about would be, these are all for kind of one-off events. But if these events are bigger, if they're more frequent, I guess we're thinking about, are we starting to move, down in the diagram on the right-hand side, which could have obviously quite important economic implications. The other thing that I'll come back to in more detail later is the international spillovers angle, and this point that severe weather events, which can affect things across borders. There's some really nice work by De Win and Pearsman, who have a panel of 75 countries, and they show that a 10% increase in global food commodity prices stemming from weather-related shocks lowers GDP by about 0.5% after 6 quarters. And interestingly, the impact of that is bigger in advanced economies than it is in emerging markets, because advanced economies often import more of these goods. But I'll come on and talk about the international dimension a little bit more in a moment. And actually, to turn to the inflation impacts, which is obviously very important for central banks, the balance here obviously depends on that balance between demand and supply that I showed in the stylized diagram earlier. So I think obviously the kind of, as I said earlier, the most obvious effect here is that severe weather events can generate negative impacts to supply. The type of disaster really matters here, which is why we did that taxonomy. So, for example, in the short term, there's evidence from some work by Miles Parker at the ECB that storms, for example, tend to have the biggest effect on food price inflation, whereas floods tend to increase headline inflation more broadly. So different impacts on inflation for different types of shocks. In addition, coming back to the work by further work by Gert Pearsman, this documents how shocks to international food prices can spill over into domestic effects of inflation, even if the shock originated abroad. So coming back to that kind of spillover point again. And then finally, I think some really interesting and more recent work by Kotz et al., which points to this possible non-linearity in some of these weather-related effects. So what they find in that paper is that hotter than usual summers can increase inflation for several months, usually through the impacts on food prices, and that the other components of consumer prices can also be affected. So to take an example, the 2022 extreme summer heat wave in Europe increased food inflation by around 0.7 percentage points after 1 year. So in terms of the policy response to these types of shocks, I think there's a couple of points that are worth noting. For natural disasters of this type, I think the predominant response is a government response, is a fiscal response rather than monetary policy, not least given that there's impacts on both demand and supply. And I think more generally, when we think of these types of shocks, the classic monetary policy response to a one-off shock of this type would be to look through the first round effects on inflation, particularly if they were judged to not be persistent. However, I think that's less clear-cut where the shocks are larger, more frequent, or more persistent. And in the Kotz et al. Work that I mentioned here, this work shows that without adaptation measures, global food price inflation may increase by around 1 to 3 percentage points a year by 2035. And that would have an effect on headline inflation of between 0.3 to 1.2%. percentage points, sorry. So obviously kind of those figures are starting to get quite. Different types of climate mitigation policies. I think broadly these fall into the three buckets that are shown on this slide. The first is kind of carbon pricing types of measures. And these measures are enacted in order to incentivize households or firms to shift to alternatives with less carbon content. And this can be done, for example, by increasing taxes levied on fossil fuels or via emissions trading systems such as the cap and trade system. An example here are the EU and UK emissions trading systems. And the UK version here, for example, covers the aviation industry and power sectors and accounts for around a quarter of the UK's greenhouse gas emissions. Canadian carbon tax here is another example. The second one is subsidies. And actually, I think probably over the last few years, we're seeing more examples of this. Essentially, these subsidies try to encourage investment in low carbon intensive activities. These subsidies will generally create new jobs and generate investment, but they also may result in some stranding of some of the existing capital stock as it's phased out. Perhaps the biggest example of this, the US Inflation Reduction Act, which came to pass in a couple of years ago, is aimed at incentivizing investments into clean energy through a combination of grants, loans, rebates, incentives, and other investments. The EU Green Deal is another example here. And then finally, these non-market-based regulatory interventions. Again, these are often to discourage investment in carbon-intensive industries and or to shift investment towards greener sectors. And to give a few examples here, the EU's Fit for 55 package includes a ban on combustion engine cars and vans, and quotas on greener fuel in ships, renewable energy, and the energy performance of buildings. We have the UK zero emission vehicle mandate as well, which sets out the proportion of net zero emission cars which manufacturers are required to produce each year. There's also an example in India where they have the Perform, Achieve and Trade scheme, which sets mandatory energy efficiency levels for 1/4 of India's total energy use. So lots of different types of policies here and lots of different things being done across different countries. And I think it's also worth saying, and I'll come back to this point, that some of these policies, if they're enacted in one country, will lead to spillovers internationally. So again, that's something that we need to think about. So this slide just really shows these policies, and the left-hand chart just shows that the proportion of global greenhouse gases covered by an emissions trading scheme or carbon pricing is increasing in the left-hand chart. And then in the right-hand chart here, we see that the stringency of various types of climate policy, as measured by the OECD's Climate Actions and Policies Measurement Framework, is also increasing over time too. So I think really these slides just show that these policies are increasing and that we need therefore to think about their effects. And so one of the first things we did when we started our work in the Network for Greening the Financial System is that we conducted a survey of the membership of the NGFS, and most of the central banks filled in the survey. This slide is a little bit complicated, but I think the key thing I would ask you to look at is the green segment at the bottom. And essentially, what the question asks is, how has your macroeconomy been affected by the consequences of the net zero transition? And if you look at the green segment, only 22% of central banks currently say it's not been affected in any significant way. And then as we move to the right of the chart, the horizon extends. So the middle chart looks at in the near future, that green segment shrinks to 14%. And then on the right-hand side, we look at kind of in the medium term, and that green segment disappears entirely. So I think this kind of really motivates why central banks are starting to think about this issue, because essentially the ones that we surveyed, most of them said, they either think it's having an effect or they don't know. And in the future, those who were saying they didn't think it would have an effect essentially collapses to zero. So that really kind of provides the basis for this work in the Network for Greening the Financial System. So second and final transmission diagram of the talk, I promise. So this is taken from the report that we've done on the impact of transition. So again, here, what we're trying to capture is that the transition policies that I spoke about previously, which are in the left-hand side of the slide here, will affect the behavior of households, firms, governments, and also the financial sector as well. So shifts in consumer prices, wages, and asset prices can happen in terms of the impact of transition policies. They can affect household income, wealth, and savings patterns, and the effects will vary in terms of the policy deployed. And I'll come on and show some examples of that in a moment. For firms, transition policies are obviously aimed to incentivize a shift in production towards greener production. And furthermore, investment decisions at a firm level will also be influenced by changes to costs, productivity, and profits, as well as the nature of the financing conditions that they face. An important point, I guess, not to forget in this is that the green transition will also impact upon governments' fiscal balances as well. So, for example, carbon pricing generates revenue, which can then be used to kind of redistribute, whereas subsidizing green technology will need to be financed either by debt issuance or new taxes. And how the governments decide to enact these policies and how they decide to recycle revenues will be really important for the effect on the macroeconomy. And again, different types of economies, those who rely on fossil fuel revenues, managing the transition will obviously be more challenging, but there may be opportunities for some countries who are producing goods or who have critical minerals, which will be important for the green transition. So again, different economies will be in different positions here. The necessary reallocation of capital also creates challenges and opportunities for banks and other investors. And of course, carbon-intensive firms may see impacts on profitability, asset valuation, and credit conditions as well, with low-carbon firms seeing the opposite effect. And change in investment flows can, of course, cause volatility in financial markets and affect the valuation of a wide range of assets. So again, there are a number of channels here. And indeed, and another important thing to think about is that expectations regarding the impact of future policy changes can also influence the behavior of the economic agents in this chart. For example, driving precautionary savings or speculative investments, which can magnify economic fluctuations. Finally, climate mitigation policies have the potential to generate significant international spillovers, as I mentioned. And as these policies will vary in stringency and coverage across countries, that can generate competitiveness impacts and potentially affect trade patterns and domestic production as well. So let me come on to two examples of the different types of policy. The macroeconomic impacts of the transition depend on the policies deployed by governments. Here I'm going to take two examples, one on carbon pricing and one on subsidies. And if you haven't read it already, I would recommend a recent speech by my colleague Catherine Mann on the Monetary Policy Committee, who goes through some of these impacts in more detail. But essentially, for carbon pricing, I think the main advantage of carbon pricing is that it directly internalizes the externality of carbon emissions, and it uses a price signal so that market forces are employed to reduce emissions. It could also be cost effective for governments in the sense that revenue can be gained from this and can be recycled and used to compensate lower income consumers who are affected by the incidence of the tax. It will impact across a number of agents in the economy. Carbon intensive firms obviously will be affected. Households will also be affected in the sense of facing higher energy prices or increased prices for other goods and services that rely on carbon intensive inputs. And of course, again, depending on whether firms or households anticipate the changes in the tax, they can adjust their behavior, even ahead of something happening. Subsidies are slightly different, may be easier to implement in the near term because their costs are less visible. However, they may be less efficient than carbon pricing and also need to be funded by other rises in taxation. In contrast to carbon pricing, the immediate impact of subsidies should increase demand and therefore support output growth, which could push up an inflation. And in this regard, I think we can think of subsidies as a little bit more like a positive demand shock, with a carbon tax being a bit more like a negative supply shock. But again, I think in the modeling here, it's important to think this through because higher taxes in other areas could counteract some of the positive effect of the subsidy. So let me just give a few examples of some of the work that we've done in terms of thinking about the effects of these policies. So the empirical research, I think, on the impacts of carbon pricing is quite mixed. A recent paper by Metcalfe and Stock find positive negligible impacts on GDP and employment, while Kanzig finds that economic activity falls temporarily and unemployment rises after a carbon pricing shock in the EU ETS. Most empirical evidence, though, I think suggests that carbon prices lead to small and transient upward inflationary pressures in models where monetary policy reacts endogenously and inflation expectations are well anchored. And there was some research the IMF published in the World Economic Outlook last year, that pointed to those type of effects. These results that I'm showing in this chart are based on some analysis that we've done at the Bank of England, which looks at a rise in carbon prices induced by a reduction in carbon credit supply in the ETS. And as you can see here, essentially, we do get this impact, which is that output falls and inflation is increased. And to take an example of one standard deviation shock, which results in a 94-cent rise in ETS prices, leads to a peak impact of 0.05% on CPI and a 0.1% fall in GDP, as we see in this chart. And in the bottom right, you can see that around half of that fall goes into the output gap and the other half into potential supply. So overall, I think this suggests that, as I was saying earlier, a rise in carbon prices could be a trade-off inducing shock for monetary policy to think about. And so just to draw on some further work at the Bank of England by my colleague Francesca De Luzio, which compares the different effects of carbon taxes and green subsidies. And the comparator here is that we use the model to say, what do you need to do to achieve a 1% fall in emissions in 1 year? And as you can see here in the bottom panels, both of these policies push up on inflation, although the inflation impact is higher and it takes longer to return to its original level under the subsidy policy. However, as you can see in the top right panel, subsidies increase output, whereas as you can see in the top left panel, carbon taxes reduce output. So I think, again, this comes to the point of subsidies looking a bit more like a positive demand shock, while carbon taxes resemble a negative supply shock. Although, of course, as I said, some of the magnitudes here are quite different across the two shocks to get that given reduction in emissions. Let me mention briefly some other work that we've done at the bank on international spillovers from overseas policies. So we've developed a two-country, two-sector DSGE model where the two sectors are kind of a green and emissions intensive sector to explore the international spillovers from foreign policy related to climate change. So let me just sort of summarize the key findings from this work. First, both carbon taxes and green subsidies result in a reallocation of resources from emission-intensive sectors to green ones in the economy imposing the policy. I think you'd expect that. Second, while the country imposing the policy shifts production to green sectors, resources are reallocated towards more emission-intensive sectors in the foreign economy, in this case, the UK. So in other words, this is the sort of classic carbon leakage effect. In both scenarios, we see green capital flows generated towards the country implementing the policy because of the comparative advantage gained. The real exchange rate adjusts in the model with the impacts depending on the policy implemented. And overall, in this model, for a small open economy like the UK, while a carbon tax overseas would raise output initially in the UK via diverting some production towards the UK, that's more than outweighed by a fall in UK export demand eventually. And in addition, because imports are a large share of the UK consumption basket, and those imports become more expensive, domestic inflation goes up. Overseas, green subsidies can raise emissions-intensive production in the UK. Sorry, overseas green subsidies can raise emissions-intensive production in the UK, but the productivity shock abroad will also increase demand for UK goods too. So again, in that scenario, inflation falls because the exchange rate appreciates and imported goods become cheaper. So to sort of summarize, an overseas carbon tax, we think, pushes output down eventually and inflation up in the UK, and an overseas green subsidy pushes output up eventually in the UK and inflation down. But I think this is quite interesting work. It's kind of relatively new work. It's not published yet, but it does show that kind of important impact for a small open economy like the UK of policies abroad. So let me just try and sum up on transition policies, the evidence that we have. I think it's fair to say that the transition policies are likely to increase inflation and inflation volatility in the near term. But I think the short-term impacts on output will really depend on the policy. Different types of climate policy can have different impacts. As I said, carbon prices may look more like a negative supply shock and subsidies more like a positive demand shock in the short run. But I think their medium-term effects will depend on the policy design, including how the carbon tax revenues are used and how subsidies are being financed. And in addition, how they affect the expectation formation of different agents. The impact of higher investment on inflation and output will depend on the interplay of supply and demand across various markets, including the extent to which the investment provides capital deepening in the green sectors, or it strands capital, for example, in the non-green sectors. To come back to this point again, I guess the other issue with climate policy is that if there's uncertainty about the future path of policies, that can obviously affect economic outcomes. And again, that's something that we need to think about. And then finally, this point on spillovers from asymmetric policies abroad, they're going to affect trade, capital flows, and the exchange rates, having an effect on output and inflation in other economies. I have one more section, but I'm going to go through it quite quickly because I think I'm slightly overrunning on time. And that is just to say that given everything I've just talked about, I think the issues on macroeconomic modeling then become quite important for central banks. And this is another chart from the survey that we did of NGFS members. And essentially the point of the chart is to say that not many central banks have formally included climate considerations into their regular models that they use to support monetary policy making. And that's because of some of the challenges highlighted on this slide: data quality, how we link climate and macro models, how we get the different linkages right between the models, and how we improve our supply side modeling. So let me just say a quick word on the current state of modeling efforts. I think probably I don't need to tell anyone in this room, I'm sure all of you are very well used to using economic models, and to say there's no such thing as the perfect model is probably an understatement. I think one thing that's been quite interesting in doing this work is to the extent that we can use our existing models, or whether we need to develop new ones, which are obviously any kind of model development exercise is a lengthy process. But I think one thing I would say is that I think particularly in terms of the transition policies, I think we can use existing models. You know, we're looking at taxes and subsidies here. Our models are well used to looking at things like that, so we can get going, essentially. The physical side of things, I think, is more challenging. It requires the integration of science and economics. There are multiple layers of uncertainty here. I mean, there's always uncertainty in economic modeling, but I think there is probably a lot more in this space. The typical models that have been used are the integrated assessment models, which date back to the work of Nordhaus in 1996. Essentially, those models work by kind of trying to link climate to the economic effects through a damage function, which essentially kind of, you know, if you can measure climate change in terms of the impact on temperature, and then you kind of put that through into the kind of the economic bit of the model, a CGE model or a DSGE model in terms of the, and then you can get out the economic effects there. Model and parameter uncertainty, of course, always applies, as it does in anything else. But I think this kind of matching of two disciplines does make things quite challenging. I think there's no silver bullet here, I think, and we may need to use multiple models or alternative approaches when we think about this issue. So let me finish this talk with some points on the implications for monetary policy. So I think what I've tried to do today is to lay out some of the evidence that climate change and the policy response to it can have macroeconomic impacts. And I think it seems pretty clear that the physical effects of climate change would push down on output in the short run. The impact on inflation will depend on how demand and supply are affected, and of course, the response of monetary policy itself. But I think it's likely that in the short term, a lot of these shocks will raise prices because of disruptions to food and goods supplies, and furthermore, the disruption to global supply chains that I mentioned in other countries, for example. So in theory, these types of supply shocks, monetary policy probably would look through the first round effects of these shocks if it was one-off. But as I mentioned earlier, if the shock is more persistent, or if it's bigger, if it's longer lived, then I think that is potentially something that we would need to think about. So I think that's a question for central banks. As these shocks become more frequent, can we just look through the effects? And I guess just to point to a bit of evidence here in conclusion, the left-hand chart is taken from the IMF, which shows the frequency of extreme natural disasters has been rising. And in the right-hand chart, it shows that the impact on global GDP from different types of climate hazard is expected to increase substantially as we move out over the next 25 years. So in that case, if we do have an increased frequency and severity of shocks, I think it could be therefore harder for monetary policy just to look through those effects. And it is something that we would need to consider if there was a sharp and persistent trade-off to manage. In terms of the transition, just to draw a few conclusions, I think my overall message in the talk has been carbon prices probably look like a supply shock and subsidies look like a demand shock. But of course, it's more complicated than that, and we need to trace through the full effects of those shocks to get a picture. I think the other thing I'd say is that it's worth noting that although some of the studies that I showed have relatively small effects so far of some of these climate policies, that's because some of these policies have been quite small so far. So there's some work by the IMF which suggests that the average global price of carbon will need to rise by around $75 a ton by 2030, whereas policies enacted so far have raised the price by around $6 a ton. So you can see that kind of if that action scales up, then you could have significantly bigger impacts. And it's possible, of course, that policy action will take place over a number of years, or the policy action is delayed and then it comes more quickly. And either way, I think this could create issues for monetary policy to think about, either a year-on-year repeated change in relative prices or quite a large change in prices over a shorter period in the future. And so I think kind of, regardless of what climate policies look like, monetary policymakers will need to understand and manage the impacts of those relative price shifts. Final slide, I promise, and then I'll conclude. One of the big issues, obviously, that central banks spend time thinking about is the equilibrium interest rate. I think it's fair to say that this is very difficult to estimate. And whenever we think about the equilibrium interest rate, there are always factors pushing up and pushing down. I think climate is no exception. On the left-hand side here, you can think of factors that could push up on the equilibrium interest rate, so a rise in green investment for decarbonising industries. But equally, you need to think about the reduced investment in carbon-intensive industries, which could push down. There could be a boost to productivity growth from green innovation. Of course, the rise in government debt associated with the need for greater subsidies could also push up on R star, and the increase in government debt associated with public investments in adaptations could also push up on R star as well. But equally, on the right-hand side, an increased risk premium from higher macro volatility or riskiness of green investment could push down on R star. Precautionary saving could rise in response to increased risk. And of course, the impact of climate shocks could destroy physical capital and reduce productivity. And there could be higher depreciation on capital from physical impacts. So again, as always, it seems with R star, there are things pushing up and things pushing down. And this is work that we want to do more of in the next few years to try and better understand these effects. There's obviously a lot out there in terms of the likely impact from climate on R star. So let me finish with my key takeaways from the lecture. So the impact, I think it's fair to say the impact of climate shocks and mitigation policies on economies are likely to increase. As I hopefully have illustrated, spillovers and cross-border impacts of different policies or different shocks in different countries will also have an important role to play. And I think for a small open economy like the UK, this angle is particularly important. In the work that we've done, we face the same challenge that many others have when we think about this issue, which is that it's a complex challenge bringing together climate science and macroeconomics. And I think there's further work that we need to do in that area to improve that. Central bank toolkits in this area are developing. My mantra in this is don't let the best be the enemy of the good. We've really got to get stuck in, and we've got to start estimating some of these effects. As I mentioned earlier, and as I showed, you can use existing models or tweaks to existing models to think about the impacts here. What we've tried to do in the Network for Greening the Financial System over the last couple of years is we've tried to build this analytical framework, which I've taken you through some of today. And what we hope is that will assist central banks across the world in their endeavours to try and model the economic impact on climate. We're now looking to the next phase of this work, and I think what we want to do is kind of taking that framework and taking those impacts as given to start thinking about how monetary policy might need to react to these effects, particularly, as I said, if they're becoming bigger, more persistent, repeated. And I think the final thing I would say is, I think I said this right up front, that we talk to a lot of central banks. Central banks have different mandates. They have different responsibilities. This work isn't about changing those responsibilities. But I think what it is saying is that all central banks need to understand the shocks that affect their economies in order to set monetary policy. And I'm hoping that through this work that we've been doing, we can try and make this a little bit clearer and help central banks when they're thinking about these issues. And that's something we'll have in common. Okay, I'll stop there. Thank you.
This one to Dutch. I see one immediately. I put one over
Afternoon, James. Richard Godfrey. It appears you're broadly supportive of climate tax like UK ETS due to its inflation dampening benefits against supply chain and food production inflation that might arise in a climate crisis.
Hi, Alex Dorr from the UKIB. There are two quick questions. So one is, what about non-linearities and physical risk and tipping points? And the second about the scale of the shocks from the physical risk and the transition risk. I got a bit lost in the 0.5s of GDP and yeah.
Sorry, could you just repeat that last question again? Just
so the scope, so the scale of the shocks from the physical risk to how they compare.
Yeah.
Hi, I'm Lisa. I guess you spoke a lot about the international spillovers, but I didn't necessarily hear the word geopolitics and whether some of the transitions, the elements of the transition, for example, like greening energy generation or some of the migration risks, mean that we're more vulnerable to geopolitical risks more generally, and for example, like oil shocks and things like that. And related to that, if we have more frequent kind of shocks from either physical damage from climate or from geopolitical risk, does that mean that we're likely to see a kind of lower threshold at which kind of expectations for inflation unanchor?
Sorry, just repeat the last question again.
Are we likely to see expectations for inflation to unanchor more frequently?
Okay. Do you want me to do those ones? Yeah. Okay, let me try and do justice to those questions. So on the kind of climate tax versus food price inflation, I think that the most important thing to say is that as a central bank, we don't take a position on kind of the policies enacted by government. I think it's very much for government to decide. I mean, I think what we're trying to do in our work is to understand what the impact either of the policy or the impact on food price inflation would be. And I think some of that evidence that I presented earlier in the lecture suggests that kind of we could see quite a big impact on inflation from these types of shocks over the next few years. And it could become of a scale that we as central banks would really need to think about when we're discharging our core responsibilities. I think the point on non-linearities and tipping points is a really good one. I mean, I was quite struck by some of that work I presented on this kind of non-linear effects of kind of temperature changes. I think we're just starting to get into that actually, to sort of try and figure that one out, because I think a lot of the modeling we've done does take this as linear. One of the really big conversations we've had in the group that I've been chairing has been, when we're thinking about physical impacts, how do we take those non-linearities into account? And when we're thinking about some of the climate modeling and we're coming to these issues around damage functions, what do the damage functions look like? I think thinking about the non-linearities is quite important, but I don't think anyone's cracked this one yet, or certainly we haven't. So that's a kind of call for modeling on my part, I think, because I think, if we're likely to face this, then we really do need to understand this. But I think a lot of what we've done so far kind of treats things as linear, and that may not be the right assumption. You asked about the scale of physical risks. I guess I was presenting some kind of evidence on average of physical risks across countries. And I think the point I was trying to make is that, first of all, those effects, I think so far on average have been quite small. They are different across different countries. But again, I think it kind of comes to this point that if we see kind of bigger shocks, more frequent, more repeated shocks, those could get bigger over time. And so they start to become more economically meaningful. I think in terms of the average GDP effects, they're quite small. Obviously, for certain countries, they can be enormous. And, some shocks are really impactful, which is where this kind of resilience threshold point comes in. And, if the country can't make the fiscal response it needs, that can be quite a big problem. On the question about geopolitics, so I think obviously kind of geopolitics is a backdrop for kind of everything we do. I could definitely see an interaction here, as you said, both with kind of the oil market or kind of the green transition. I think kind of one of the really big international issues at the moment is this issue of kind of financing the green transition, and a lot of financing needs to go to emerging market economies, and I think that's something we need to think quite hard about as economists, because I think those capital flows could be sustained. It will need to be sustained over a number of years. Again, that could have kind of economic effects. On your point about expectations, can they de-anchor? I guess what I would say is it's kind of the job of central banks to make sure they don't, which again is kind of why I think it's important that we understand these effects. And again, if these shocks are persistent, if they're repeated, if they build up over a number of years and they have a sizable impact on inflation, then it becomes important for us to make sure we don't see that inflation de-anchoring in response to any of these shocks.
Okay, thanks so much. Got one over there, one there.
Emilia Petrovic-Huda from Cambridge Econometrics. You mentioned impact on government fiscal balances when it comes to transition risk, but you didn't quite talk about it that much in the physical risks. And I'm wondering whether it makes sense to also disaggregate between public and private costs when it comes to physical damages.
Yeah, Gareth Evans from Temasek. Sorry. You sort of posed the question, will monetary policy look through the impact on inflation? Does that mean you're not including a traditional monetary policy response in your modelling work? And if you were, what would be the outcomes? You have in both flow diagrams financial conditions as being one of the factors. Obviously, one would assume you're talking about interest rates. Obviously, we've had a big supply shock with COVID, and initially there was a view that monetary policy would look through, and it didn't in the end. So what makes you think this will be any different?
Richard Clark, Ortec Finance, acute physical risk. Very insightful talk. You showed and talked a lot about the acute physical risk, the extreme weather, but also chronic risk is there quite boldly in the NGEF scenarios. Would you like to comment on how you see a chronic risk going forward? For example, there's been a paper recently, Coxley and Wentz, about some very profound impacts from chronic and how that might impact the economy.
Yep. Shall I respond to that? So on your point about the fiscal effects of physical risks and splitting it up between public and private costs, I think that's a really good point. I don't think we've got to that level of granularity yet in the work that we've done, but I could certainly see that as an area for future work. And I think the sort of the split there in terms of both the kind of, you know, the ability of governments to respond and to kind of take action in the effect of, to sort of clean up after a shock, but also the ability of the insurance sector to kind of ensure what's going on there. I think that's quite an interesting kind of area to unpack. We haven't unpacked it that much yet, but I think in future work, we could definitely look at that. In terms of monetary policy, looking through, I guess just to sort of be clear on this point, I think what I was trying to say was, for sort of small shocks that have a small direct effect on prices, the classic thing might be to look through the first round effects of that. But I think, you know, the point I wanted to bring across was that if we have a number of these shocks, if these shocks get bigger, if they come one after the other, then I think kind of, you know, monetary policymakers would need to take that into account. You couldn't just look through a series of, you know, large one-off shocks. In terms of your point about modelling, I mean, one of the things that I think is interesting in some of the modelling, and I mentioned the work the IMF put out in their World Economic Outlook last spring, they show in that work that actually the effects of transition on growth and inflation could be quite small. And I think one thing that's interesting about that work is it's done in models with forward-looking agents, monetary policy fully responding. And I think there's an interesting question about when you relax some of those assumptions, do those effects get bigger? It's a kind of classic, if everyone's forward-looking and everyone reacts, then kind of you don't get very many effects. So I think, again, that's something interesting to unpack, and, you know, the role of expectations, inflation expectations, if this is a kind of a year-on-year change, and how monetary policy would need to react to that. So I'm sort of posing that more as kind of food for thought for monetary policy makers, rather than kind of being prescriptive about a specific monetary policy response. On your point about acute versus chronic effects, I think you're right. I think I know the paper you're referring to, and I think it begs a really interesting question, actually, on kind of, you know, are those chronic effects increasing? What do we do about them? I think, again, this is a sort of an interesting area for inquiry. You know, what we've tried to do in the framework that we've put together is to kind of nest both the acute and the chronic shocks and the impacts that they're going to have. But if there are some non-linearities in those shocks, then I think that's something we need to think more about, because as I sort of said in response to the other question, I think a lot of our modelling is linear at the moment. And I think this is a definite area for future inquiry, you know, as we move forward through time.
Yeah. Hi, David Owen from Saltmarsh Economics. Thank you very much, James, for a very, very comprehensive, excellent presentation. An unfair question, perhaps, but I'm going to ask it. You've already referenced the excellent speech by Catherine Mann, but I have to say, comparing across to the ECB, and we follow the ECB very closely, obviously they've got a much more complicated balance sheet with lots of corporates still on that balance sheet, which obviously comprise all brown assets. They're more exposed, potentially in certain regions of some countries, to more extreme climate events than here, perhaps in the UK. So they may worry more about these things, you know, very hot summers over multi-day periods. But we've really yet to see the MPC grapple with this whole issue of climate change. We look at the ECB, hardly a week goes by without an executive board member, even Christine Lagarde referencing it in press conferences. But, you know, it's quite clearly on their agenda almost every week. Somebody is talking about this. So, you know, I've been following the bank, obviously, on this whole issue for years. And you're quite right, very early on, from a financial stability point of view. But I just wonder whether things are going to change in terms of there's going to be much more focus on this from a monetary policy perspective as well. Thank you very much for an excellent speech.
Thanks. Yes, can I echo that? Thanks, James. You only have one slide, the relationship between climate transition and OnStar, and that's an issue that I'm really quite interested in. I don't think there's been a huge amount of work on it. So a little plea, if you like, that if the bank could maybe start thinking about that and tell us what you think. One channel that wasn't in there, another plea, if you like, was I suspect a lot of the transition can be achieved through not net new investment, but replacement investment. And so then the key question for the relationship between the transition and OnStar becomes how costly
frankly, is it to replace, I don't know, 5 million or something. So if there are important impacts on the cost of capital coming from transition, and that has an impact ultimately on our stuff, it would be great to get a sense of how large those might be. And I don't often see much analysis of that question.
Again, Paul Fisher from various affiliations. I just wonder, the sorts of analysis you present here is the sort of thing you do see coming through quite a lot of places, but it's all very marginal analysis, which is good for looking at small changes to policies, and you look at the small change benefits and costs associated with that. But the big risk here is the existential risk, which we risk missing it completely, which is we have unmitigated climate change, and at some point the world economy completely collapses because some countries become unlivable, you get mass wars, migration. Some countries are actually already bordering on that. Pakistan's floods, some of the wildfires across southern Europe, destroying tourist industries and things like that. But when you do this modelling, you have to have a base case which is stable. You can't have an unstable sort of existential risk case. And so we actually assume away the risk we're really worried about, which is the existential one. And if you compare with the existential outcome, of course, all of these things are massively beneficial, it turns out, for inflation compared with the global crisis case. I've not seen anybody really address that, try to quantify what that global crisis might look like to aid us comparisons when looking at these marginal changes.
Okay, another great set of questions. So on the question of what are we doing at the bank in the monetary policy space? So I think really, as I sort of said, this is the next area we're turning to. We've been talking internally about this. We've been starting to do some of the modelling that I've sort of presented some of the work today, and I think this is a sort of a case of as the effects here grow, they become relevant for the modelling, for the forecasting, and it's really kind of how do we think about that and how do we embed it. And I think this kind of links to the work that we're trying to do through the Network for Greening the Financial System, which is many central banks are in this position. And the ECB has been a really fantastic contributor to the network, has done a lot of work and analysis in this area. And so I think at the bank, this is work we're doing and we're trying to understand. But, as I said, we kind of started on the financial stability side and we're now moving to the macro side. So it's work in progress, if you like. And I think, Catherine's speech is a really good example of an MPC member thinking about these issues and talking about them in public. On the questions on R-star and replacement investment, yeah, very much agree. I mean, the sort of the table is sort of an initial take, but I think kind of in the second phase of the work that we want to do at the NGFS, I think we want to think about that kind of question of R-star, because I tend to sort of, if I have a sort of Taylor rule in my head for monetary policy and I think about the different bits, we sort of started on the kind of how does it affect kind of demand and supply and inflation relative to target. But the other bit I then need to think about is kind of where is R-star? And obviously that's kind of really big question for central banks, lots of different factors. There's quite a lot of kind of discussion of this, I think, in public, but I think you're right that kind of we need kind of more research in that area. How is this going to affect investment flows? How is it therefore going to knock on to R-star? So that's definitely something we'd like to do, but we just, that's the bit we kind of haven't quite got to yet. On the existential point, I think it's a great question. I mean, it's sort of, I sort of think central banks are facing a lot of existential questions at the moment. I mean, we had a kind of, with the COVID shock, we had to start thinking about kind of the interaction between health and the economy, some really big effects on both demand, supply and inflation. So I think we are starting to have to think about issues like this. I think you're right to say that kind of, the modelling and the analysis that's been done so far looks at small shocks. And I think it kind of comes back to the point that some of the other speakers have raised on this question of non-linearities. How do those work? I'd sort of say again that I think a lot of the work we've done in this space is kind of linear, and probably the next frontier is to think about the non-linearity. I mean, one of the things we're always trying to do as a central bank is to kind of, as you know, Paul, from your time there, is to sort of think about kind of challenging issues and how we would respond to them. So this is kind of definitely something I would put in the sort of we need to think about it more list. I think it's a fair question.
Okay, we've got time probably for just a couple more, although I did want to comment on the R-Star thing, but I started doing some work on R-Star at the bank also before I left. So the fact there hasn't been much work done on R-Star is all my fault. Okay, any more questions before we wrap up? Got one over there again, and one right to the back.
Okay, thanks for the opportunity for one more question. Just again, a question about damage functions for physical risks. If you could go into more specifics, which damage functions do you choose? If you chose any specific ones to use, both for chronic and acute risks, if you chose different ones, and how do you make that decision? Because obviously there's so many different research with different damage functions.
Arna Bhattacharjee, public policy team, NISA. A fantastic presentation. Very quick one. I'm wondering about the medium to the long term, right? At the moment, we are looking at the business cycle frequency. Some of these impacts might be very long term, and some of your impulse responses actually show fairly long term, return back to equilibrium. Now, with that in mind, is there a case for thinking about our models differently? Perhaps this relates to the nonlinear question as well. But yeah, so when do we start thinking about that?
Yeah. So on the damage function, so what we have coming out in a couple of months is a paper which kind of summarizes the modeling work of central banks and the different approaches. And I think kind of, in different kind of studies and in different central banks, we've looked at this in different ways. So I don't think I'd want to be kind of too specific on that point to say there's kind of one specific damage function. I think, different people have looked at this in different ways, and I think there's kind of value in that kind of heterogeneous approach. On the question about the medium to long term, so I think what's interesting about this is kind of, I think with the scenarios work that I was describing from the Network for Greening the Financial System and some of the work that we've done on the financial sector side, actually we started with that long-term perspective, and we started with the kind of the long-term impacts. What we've been trying to do more recently is to sort of say, well, as these shocks become bigger, as they become more proximate, as kind of policy action grows, they may actually have short-term impacts, and so we need to think about the kind of the short-term dynamics. So I don't think the kind of the medium to long term is neglected. I think it's covered in other areas, but maybe the challenge is to kind of join the two things up. And I think to your point, I think what I would say is kind of back to this point about if shocks are bigger, more persistent, repeated, then you're right, they're going to have an effect beyond the short run horizon, and that's something that we need to think about.
Good. Well, we've had a wonderful talk, an excellent Q&A session. Before we thank James Kim, though, we do have this medal, I guess, which is kind of like a nice little reward for giving us a talk. So thank you. There you go.
Thank you very much, Steve.
The only thing that remains is for me to let you know that there are actually some drinks and nibbles right next door. So please go and join the conversation there.